Hello friends, welcome to the February edition of Monthly Viewpoints. The volatility seen in the equity markets in 2018 continued in Jan 2019, while on the one hand, global macro concerns moderated and sentiments for emerging markets got boosted by dovish commentary from the US Fed. On the other hand, domestic equity market sentiments got impacted by a mixed Q3 reporting season as well as investor concerns in companies with perceived lapses in corporate governance. Starting with the global macro, the US Fed has signaled that it will not be raising rates for some time and also that it will be flexible in its quantitative tapering program. This is a reversal from its earlier bias towards a tighter monetary policy. With expectations of further rate hikes from the Fed having faded, the strength of the dollar should be capped. This is positive for emerging markets, including India. The US and China are also continuing the negotiations to seek out a resolution on the trade war front. Crude prices have rallied almost 23% from their lows, largely on account of supply cuts by the OPEC Plus coalition. However, they are still within India's comfort zone as the crude prices are being capped because of concerns on slowing global growth as well as uncertainties regarding the US-China trade war. Brent crude prices are expected to be range-bound between $50 to $70 per barrel, which is positive for oil importing emerging economies, including India. Considering these developments, emerging markets have seen positive FPI flows over the past month. Coming to domestic markets, the rupee depreciated almost 2% in January, largely on the back of the rise in the crude oil prices. However, crude prices are still almost 30% below the October highs, and India's CAD is likely to moderate. Hence, external stability is not much of a concern right now. With inflation consistently undershooting RBI's estimates and well below the RBI target of 4%, the RBI has reduced its policy rate by 25 basis points, shifted its stance to neutral from calibrated tightening, and also reduced the inflation forecast for next year. The RBI governor's statement, "There is room to act," clearly suggests that this is not a one and done cut. The government has shown fiscal prudence in the interim budget for FY20, even as it has provided a stimulus of almost Rs 1 lakh crore to the economy. Direct income support for farmers as well as tax benefits for the low-income middle class should increase the disposable income. Sectors which are likely to benefit include agrochemicals and agri-inputs, consumer staples and small-ticket consumer durables, retail, two-wheelers, housing finance companies, retail-oriented banks, and NBFCs. The third quarter earnings season is in progress. Around 40 of the Nifty 50 companies have reported their earnings thus far, and out of that, two-thirds have come in either above or in line with estimate. While the Nifty companies have shown robust revenue growth, the operating margin and PAT have got impacted because the companies had to face the full impact of the tightened liquidity, rise in interest rates, as well as rising material prices and energy costs. Private sector banks, corporate banks and select NBFCs, IT companies, cap goods and infra, and select consumption-oriented companies have reported a decent set of numbers. Coming to our view on the equity markets. In Jan, the large cap Nifty index was flat, but the mid cap and small cap indices declined almost 5%. We believe that the downside risk to the Nifty has eased off. However, the markets are likely to be range bound on account of global macro concerns as well as domestic developments, including the general elections scheduled this year. The broader earnings growth for the market continues to be supportive. The Nifty forward valuations are at 17 times on a PE basis. Hence, valuations are providing a cushion to the overall markets. We would recommend that investors continue to build equity exposure for the long term, preferably through SIPs and STPs over the next 6 months rather than lump sum investments. It would also be prudent for investors to allocate 20% of their corpus to mid-cap and small-cap funds as their valuations have become attractive. Select themes that we are participating in include consumption, which covers the consumer and consumer discretionary sectors, and financials, which includes private banks, corporate banks, and select NBFCs. We offer a basket of suitable funds for equity investors to choose from. Thank you and happy investing.